Hi, everyone. You're watching episode 1 of Zapper TV. All right. I hope everyone is as impressed as I am by our new animated intro. So welcome. This is Yield TV rebranded as Zapper TV. We're going to keep a very similar format. Our goal with Zapper TV is to continue to interview, some of the brightest minds, some of the brightest investors, builders in the DeFi and crypto space. Because at Zapper, we really believe that one of the challenges to mass adoption is simply education. So we're hoping this can be an outlet for more of you to learn all about DeFi. So on that note, today we get to interview Haseeb Qureshi, who is he's an investor, he's an educator, he's a user of DeFi. So Haseeb is managing partner at Dragonfly Capital. He's published a comprehensive blockchain and crypto course at nakamoto.com. You should check that out. It's actually a resource that I've used to learn from before. He also has previously developed software at learn.com and Airbnb. And prior to his career in crypto and tech, it's always worth noting, like, he had an awesome career in poker. And I think that has informed a lot of interesting perspective that you bring to our space. So anyways, on that note, Haseeb, welcome to Zapper TV. How are you doing?
Thank you. First of all, thanks for having me. That was a very generous introduction, and I'm doing great, despite the fact that it's been a really bizarre couple of weeks in crypto. So I'm less slept than I usually am, but other than that, I'm doing well.
It has, and that is part of what we'll dig into today. I definitely felt like we were brainstorming, like, who should we have on this episode 1? And we're like, we need someone who can talk as a macro investor, but someone who's in the weeds, who like you've written posts on automated market makers to, I mean, God, they're like, you are definitely like someone who I've listened to some podcasts and been like, Haseeb is just smarter than me, and I'm going to accept I don't understand everything that he's talking about, but maybe someday I will.
Trust me that it doesn't feel that way from my perspective. It feels like I barely understand what's going on in this industry.
Yeah, that's the secret. People need to realize over time that we're all sort of challenged and struggling together to understand and make sense of all of this. So I gave actually quite a bit on your background, but I would love to hear the story of how did you get into crypto? We all sort of share this common origin of like, what was the spark? So yeah, how did you originally discover crypto?
So I first got into crypto. Actually, I bought my first crypto back in 2015, but I didn't really think a whole lot about it. I had some friends, mostly back from when I was a poker player, who got early into Bitcoin and crypto, but I never really got it. It sort of felt like, okay, it's like a way to buy drugs online or whatever. And it wasn't until I was working at Airbnb that crypto really clicked for me. So when I was at Airbnb, I was working as a software engineer on the payments front team. Ironically, I was actually the same team that Brian Armstrong was on when he left to go co-found Coinbase. And so I think there's something kind of with that particular team, because we were working on payments fraud. And payments fraud, well, when you're working on payments fraud, you're always thinking adversarially about how can people take advantage of the current way that the financial payment system is architected, both in the US and internationally, because Airbnb is a global it's a global company, it's a travel company. And so when you have to pay people all over the world in 50 plus countries, you end up coming to understand the way the global payment system works, which is that it kind of doesn't work. Like it's kind of a complete mess. Are you allowed to curse on the show? I don't know.
You are.
Okay.
Very welcome.
It's a fucking mess. It's an absolute fucking mess. Like basically you have all these systems that don't really talk to each other particularly well. Like, the deeper you look at it, when you use Airbnb, you get this perspective of like, okay, you sort of swipe a credit card and then it just kind of magically works and your money shows up on the doorstep of whoever is hosting you. But in reality, there are all these sorts of old systems that were built in the 80s that don't really talk to each other. Like there's CSVs that get emailed to each other every midnight and manually reconciled. There's there are places where digital payments doesn't really work, and so you have a contractor who mails checks to a PO box, and you hit an API to ask if the PO box got it yet. It's just a nightmare. And as an engineer, when you see a system like this, it's so broken, your first instinct is like, oh, we should just throw this out and start over. We should build a system that actually gives you the properties you care about in the world we live in today, which is, for a company like Airbnb, Airbnb is global, right. Airbnb is digital first, and it's 24/7, right? And that doesn't describe the financial system that we actually have.
Yeah.
And it was around that time that it really dawned on me that that's what crypto is. Crypto is a bunch of engineers and philosophers and economists and cryptographers who got together and said, knowing what we know today about peer-to-peer networks and cryptography and game theory and whatever, how would you rebuild a monetary system for the 21st century? Well, it's like, okay, well, maybe you would make it peer-to-peer. Maybe you would make it decentralized. Maybe you would make it use public-private key cryptography. Maybe you would make the monetary policy algorithmic. All these different things, and you sort of realize, this was back in the advent of all these coins arising in
right.
2016 and 2017. You realize like, oh, each of these different coins is a different answer to that question of how should a monetary system be architected. And that was when it dawned on me that this stuff is going to change the world, period. There's no way that the way we did money 100 years ago is the way we're going to do money 100 years from now, period. There's just no question in my mind that's the case. And now, look, I'm not somebody who believes that we're all going to be paying each other with Bitcoin in 20 years or whatever, but I am somebody who believes that what happens in this industry is absolutely going to change the trajectory of money. And that's what got me excited to come on board into crypto and start chasing the blockchain.
I think lately we've all noticed that there's a lot of very credible and respected people in the world of traditional finance who are speaking out about Ethereum specifically. Some of them are even going as specific as talking about DeFi. And I think that has a lot to do with the fact that they recognize like these are the same constructs of what I use to earn yield on my own money, on the money that they've managed of others. And they're like, hey, this is different than Bitcoin. Like obviously neither one of us is, I'm not a Bitcoin hater. I still continue to hold Bitcoin. I think that it is an innovation, but it's a limited innovation. I wouldn't say that outside of my crypto like group because, folks run with sound bites like that. But yeah, it's limited. And that's why DeFi has been this like, oh shit moment. This thing lets me do everything that I could have wanted to do. And in fact, I would say I can speak personally to the fact coming from a lower middle class family, a lot of what I can do with my money in DeFi, most of it, 90% of it, I didn't even know about growing up. My parents still to this day have no idea what's up or down with their money. They just know they have a savings account at the bank.
Right.
That's what's so radical is opening up all of these mechanisms for earning money with your money, but in a peer-to-peer fashion on a decentralized network using cryptography. It's just it's radical. Maybe Haseeb, we should like dive right into like the elephant in the room. How do you make sense of what's happened over the last few weeks? We obviously we all recognize we're living through a bull run. We very possibly are still in a bull run. But you see the markets nuke 50, 60, 70%. And it's like, whoa, like, I mean, fundamentally what has changed, it's hard to tell if anything has, but I do recognize that we had a price drop of 50% in Ether and Bitcoin. So it's like, how do you think about that? What are you telling your own investors? What do your friends and family ask you about?
Well, to me, it was pretty simple, is that crypto is a very cyclical market. And crypto is also a market that, unlike a lot of other technologies, it enables its own speculation, which is kind of trippy if you sort of think about it. So naturally, relative to other technologies, there's going to be more volatility embedded into crypto because you get, for most things, like if you look at like green energy or renewables or whatever, there's not necessarily the same kind of like every single day mark to market, like you see exactly how exuberant people are about this particular thing. If you did, you would see more volatility in those different technologies, but there's no one index of the entire technology that you can just bet on. In crypto, there is. You can bet on the price of Bitcoin. You can bet on the price of ETH. So that's one thing. The second thing more broadly is that actually, it was around the time that the Elon tweet where he sort of, was like, oh, Bitcoin is not ESG enough. We're going to stop accepting them for buying Teslas. To me, that was the moment that was like, okay, I think the market's going to pull back here.
Yeah.
And the real reason why, in my mind, is not because Elon in particular matters that much to obviously he does on a literal sense, just because the market, clearly Elon was responsible for a lot of the enthusiasm and the consensus building that happened early on this year. And, obviously the rise of Dogecoin, he was responsible for that as well. But the bigger thing is that if the whole market drops 20% off a single guy tweeting that he's no longer going to accept Bitcoin for cars, then it's a sign of okay, is everything just Dogecoin at this point? Is everything just a giant meme that is going up? And it just shows that there's not enough confidence in these prices. And I don't think there's going to be for a while, really. I remember talking to investors who were just like, oh, I think ETH is going to be 10 trillion before too long. And I'm just like, okay, guys, how confident were you that ETH was worth 1 trillion or that ETH is worth half a trillion? Right now, the thing about ETH is that there's still, although there's a lot of enthusiasm about ETH, and I share that enthusiasm, we still don't even really know what ETH is, in the sense that, is ETH the equity of Ethereum? If you talk to Wall Street, they think it's the equity of Ethereum. That's the way they talk about it.
Yeah, totally.
Of course, Ethereum doesn't have equity, right? It's not literally the equity of Ethereum. Is ETH a commodity? Is it the oil or / gas for smart contracts? Is that the way to think about Ether? Or is it money? Is MV equals PQ? Is that what it is? Is it the degree to which people are using ETH as a monetary asset? If so, who's using it as a monetary asset, and how big is that monetary base, and how sticky is it? We don't know. Nobody has a good answer to any of these questions. Bitcoin, it's like, oh, okay, digital gold. I see how big gold is. I see the adoption curve. You can back out a floor at which people will just buy up unlimited Bitcoin at a certain price. But for ETH, we don't have that yet. I think the market is still itself very uncertain about if there's a lot of volatility in the sentiment around ETH. Where's the floor? I don't think there's a good fundamental reason yet. Right now, it's mostly animal spirits that are driving the demand for Ether, and that's okay. Look, that's where we're at. That's fine. Obviously, there are catalysts on the horizon, like EIP 5059 and the merge, and I think these things are going to be good. And I think most of the investors in the space are converging around those as being important signposts. But what is ETH? We still don't know. And so, to me, it's not surprising that you're going to see a lot of volatility if nobody understands the asset.
Yeah, so one conversation that really sticks with me, where I was like, okay, this is insight into what billionaires think about, and what the largest capital allocators in the world think about in terms of Ethereum, DeFi, Bitcoin, and so on. So around the time that Mark Cuban started becoming very vocal and very active in our community, I had reached out through Twitter and was blown away when he responded to me. I basically said, "Hey, Mark, love what what you're sharing. If you ever need help navigating any of these DeFi projects, let me know." Anyone who's interacted with Mark knows by now he's very kind. He's very he's oddly generous with his time. And at the time he had just said, "Yeah, what narratives are interesting to you in DeFi?" That was the one and only question he asked me. And this was before he was an investor, obviously, in Zapper. And I found myself, reminded that no matter who is allocating what capital where, we're all human beings, and we're all looking for what's the most compelling story that I believe more people will buy into. And with Ether now, there's no doubt. I heard it was Kyle, I can't remember his last name, from 3 Arrows Capital, but he was talking all about on the Bankless podcast about just the fact that people are paying such an unreal amount of fees to use Ethereum, and that is a screaming indicator of the demand now and in the future to continue to use Ethereum pending some sort of black swan event. And so, that to me has been, that's what's really stuck out, regardless of what happens in the market. None of us can tell what's, I can't predict what will happen tomorrow or next week. I can't even predict 6 months out. But when people talk about, I think Ether could be 10 trillion in market cap, well, give me a timeline, give me, and
Right.
and that's where most are willing to admit, I don't really know, but I believe in the next decade or in my lifetime, it's going to happen. I'm curious, like with, so with where you sit with Dragonfly Capital, I mean, you are interfacing with, some of the best teams in DeFi, but then of course, like, you have the folks who actually invest money into your fund. I'm wondering, like, what are some of the light bulb moments for your investors when let's pretend we've got someone new who wants to allocate to the fund and they're unsure of this DeFi thing. Like, what are the stories or narratives that you find are most compelling for them to get involved?
So I think there are two stories I like to tell about DeFi that I think really help it click for a lot of the folks who we talk to in the fund. So the first is around like why DeFi is, a lot of people are like, well, this DeFi thing just kind of popped up a year ago. I keep hearing about it. Like, this seems kind of random that now you guys are talking about DeFi. Before it was ICOs, and before it was this, before it was that. And here's the story that I like to tell about how DeFi is the natural progression of crypto. A lot of people, especially on the institutional side, a lot of folks, when they hear about crypto, they think blockchain. And they think, okay, well, crypto's fine, but like, when is blockchain really going to be useful? Because I hear it's great for trust and supply chains and for this and for that. I'm just like, well, hold on. A lot of those narratives were really invented by consultants, mostly in 2017. And then, every time blockchain, like crypto starts to really work, you basically see consultants start to like try to pull out this primitive and see if they can market it to, in order to sell other things. But the reality is the only things that have ever really worked in crypto, there's actually relatively few things that have ever actually worked. The first thing that worked in crypto was Bitcoin. So Bitcoin started in 2008, and Bitcoin, essentially at this point, we understand that it's effectively digital gold. Very, very simple financial technology, right? I send you money, you send me money, that's it.
That's right.
And Bitcoin, basically, if you think about gold, in the normal financial world, gold was first invented as a financial technology, basically used as a medium of payment back in ancient Egypt, right? So that's, like 5,000 BC or something. Now, the next real innovation that happened in crypto was 7 years later with the launch of Ethereum in 2015. Ethereum enabled what we now call smart contracts. And smart contracts is a very simple idea. It's just that, we can write an agreement that decides when I send you money or when you send me money, right? So, now we've gotten to the point where instead of just paying us money, we have arbitrary agreements. And that takes you to, when were financial contracts first created? Well, it's ancient Sumeria. That's, 3,500 BC, we have financial contracts, right? So it's over 1,000 years later that we get to that financial technology. Now, almost immediately after the invention of Ethereum, what happens? What do people start doing? Well, the first thing is gambling. Second thing is ICOs, right? So
yeah.
ICOs, if you think about it, what were ICOs? We try to, compartmentalize them and kind of put them in this box, and we never talk about them anymore. But ICOs were capital formation.
Right.
They were the joint stock corporation. It's, let's band together money. You pool your money together. I'll go build something, and if I make money on it, I'll pay you guys back, right? And give you some of the profits. That takes you to, the East India Company in the 1500s, right? That's when we had the first joint stock corporation. That's what ICOs were. And, naturally they end up growing and then collapsing when they realized that there was very little investor protections around them. But, after, if you sort of put these three side by side, right? Every single one of them is a step forward in the complexity of financial technology. Everything that's worked in crypto has always been about financial technology. And now we have lending, borrowing, trading, insurance, derivatives, blah, blah. We have this whole new ecosystem of different financial technology that's really starting to work on Ethereum. And this whole category we now call DeFi. But really, it's a continuation of what started with Bitcoin. Like, it's the inevitable progression of once you build one part of the financial stack, you just keep going. You keep building more and more layers on top of it. And at some point you call this layer DeFi. But the whole thing in my mind is decentralized financial technology. From the very beginning, that's what whole crypto has always been about. So that's the first narrative that I like to tell. The second narrative I like to tell is that a lot of people are like, okay, well, fine. Okay, decentralized finance is great, but like, isn't just a bunch of people like just jerking themselves off with tokens, like speculating on other speculators? Like, where is the actual utility of this? Like, where is this going to go besides I can borrow, ETH to go long, some other shitty token? It's like, okay, yes, fine. Look, right now, yeah, there's a lot of speculation. There's a lot of recursiveness in crypto.
Yeah.
You're absolutely right. That is correct. Well, the first thing, of course, is that there's already, tens of billions of dollars in crypto, of USD, just through
Right.
stablecoins, right? So clearly, to some extent, there are a lot of real assets in crypto today. But
Yeah.
but fine, most of it is ultimately being traded in and out of the crypto assets. The first thing is that, of course, in the regular internet, if you had seen the internet in the early 90s, it looked kind of similar in that it was mostly kind of circle jerky of just like a bunch of nerds talking about nerd shit on like these early forums or early blogs or whatever, or like their own personal websites. And it's like, okay, well, how is anyone going to ever care about this? Where's the commerce? Where's the real businesses? Where's the real discovery? Right? Like,
Yeah.
okay, yeah, well, look, early on, you had little attempts, like Time Warner put up a website, back in the day, but they didn't really know what they were doing, right? People hadn't figured out how this stuff was going to go mainstream. But it's very clear that the same core ideas that led to the early forums and early blogs and early websites, once the real world and sort of mass adoption came along and the infrastructure was there, all this stuff ended up scaling up where it's not about nerd shit anymore, it's about regular stuff. Right? In the same way, the primitives of DeFi right now, where it's like, okay, you borrow and lend ETH. Okay, well, who cares about borrowing and lending ETH? Well, eventually, already you can borrow and lend dollars, but pretty soon you will borrow and lend almost everything. You just need those things to end up finding their way onto the blockchain. But the primitives are general. The primitives work with anything that you put in there. So it's a matter of time until we see more and more assets find their way onto public blockchains and more users getting their utility out of what is happening on these public blockchains. But at the end of the day, already, even without assets, right? Let's say that we're never going to get to a place where, for example, you have tokenized S&P 500 on the blockchain. Mm-hmm. Well, fine. You don't necessarily need that, right? You can use something like UMA or Synthetics or Mirror to create synthetic assets that track the underlying value of a lot of these real world assets that we care about. At which point, I'm imagining a world where, like, my grandmother, who lives in Pakistan, right? She's super old school. She, basically, in Pakistan, they the government has been, and the rupee, which is the currency there, has been such a mess that, old school people, they trust gold. Mm-hmm. Gold is their store of value, right? And so my grandmother, she has a chest under her bed. She takes the chest out, puts gold in there, and looks at it, and that's how she thinks about financial planning and inheritance, right? Like, that's the way it works over there.
Absolutely. Why
does my grandmother not have a diversified portfolio the same way that you and I have, or you're diversified? Maybe you're not diversified. Why doesn't she have the same financial advice that you or I have in the first world? The answer is not because she's stupid. It's that she doesn't have access. She can't, right? It's just not available to her. And so there's going to be a point in the future where my grandmother, or the grandmother of the future, is going to have a mobile phone that she can, swap her rupees to ETH or whatever, and use that to buy a synthetic exposure to the S&P 500, to Apple stock, or to Tesla stock, or to bonds, or to whatever she wants.
Yeah,
it's going to create this kind of global, Amazon, where you can buy any financial asset in the world, and that future is not that far away. The technology is almost there. It's just a matter of the onboarding, the scalability. There's some core technical problems that need to get solved, but it's coming. That is going to be fucking huge, and that's the vision of DeFi that I have no doubt is going to be absolutely disruptive.
Yeah, that's really well said. I need to, I'll just take that soundbite, listen to it in the morning when I wake up, and everyone's like, "What do you work on? What is this DeFi thing?" Like, no, I want to hone in on what you think then we need in order to, get to that sort of mass adoption, and it goes beyond patience. So I buy into this same argument that, listen, I think I just said this because I was on I was on this Web3 panel with Cami Russo. There is no one who has tried DeFi who said afterwards they're like, no, I'm good. Everyone that tries this and realizes all the opportunities, if you go to zapper.fi/farm, there's like 600 different yield farming opportunities. Once you can get past that initial hurdle, the setting up a MetaMask, setting up any crypto wallet, getting some fiat in, things that are pretty unsettling if you're new to this. Once you get past that, you're like, oh, well, this is fucking awesome. I'm never going back. And it's kind of like searching for someone nowadays who said, yeah, I tried email years ago, but I'm a US mail maximalist. What can I say? It's the greatest, best mail system that was ever created. I don't like email. That is just not true. It's impossible to unsee the value of what you can do in DeFi. However, I think what you called out with your grandmother, and what I worry about is there's information asymmetry right now. Like, we need to make sure that we are doing everything to right the wrongs of what happened in traditional finance, where most people just are not financially literate. Financial literacy, I guess, is essentially the core problem. So it's the access you talk about with something like a mobile phone. It's, of course, the ability to transact, which, like, that ability has been hindered for many. As much as I love my dear Ethereum, we boxed out a lot of people in the past year, even with gas prices lower now. But I guess, what else do you think about, like, I'm almost asking for like your mental model as an investor. There's themes to what you're investing in and how you want to build that portfolio that reflects the future so that you can capture that upside. What else are you at Dragonfly investing in or looking for that can help DeFi to realize this, this future of mass adoption?
Well, the biggest story, most obviously in my mind, is scaling. Like that,
Yeah.
as you've seen this huge influx in demand over the last year, basically, it's become really clear that like Ethereum 1.0 just can't handle all of the demand that's coming its way. And as a result, we're seeing more and more DeFi, go multi-chain. And there's an increasing awareness that Ethereum needs an answer to this. So there are, broadly speaking, actually, I did a talk about this at Consensus. I think there are basically three paths of how you scale DeFi. Path number one is via layer twos. Path number two is via interoperability protocols like Cosmos or Polkadot or Acceler or other things that allow you to do cross-chain messaging and cross-chain asset transfers. And way number three is just through multi-chain that bridges back to Ethereum. Now, number three is effectively the way we're doing it today. Like, DeFi is scaling, but it's scaling via bidirectional bridges to Ethereum, most of which are pretty janky, right? So you have like Binance Smart Chain, you have Polygon, you have Avalanche, you have Solana. All these chains bridge directly to Ethereum, and there's no common standard. Most of them are multi-sig, so they're all like kind of jank. And but effectively, that's the way it's happening, right? Like, Polygon obviously has been growing really, really dramatically. It's just a multi-sig that they're using to connect the bridges, and it's basically its own layer one. That's a proof of stake network that connects back. And now we're seeing enormous amounts of transaction volume on these other chains. The transaction volume is there because Ethereum is so expensive, and Ethereum is not scaling, and the demand is just not, like, the supply of block space is not catching up to demand. So in the absence of a expansion in supply, people find substitutes. That's like economics 101. And right now, those substitutes are being found in other layer ones before the layer twos and before these other scaling solutions really come into their own. Of course, Ethereum 2.0 is the ideal eventual scaling solution, but now it seems increasingly likely that Ethereum 2.0 is never going to actually do phase two, which is the point where you can actually execute smart contracts directly on Ethereum 2.0. Vitalik has sort of murmured that, like, maybe we'll just do phase one, where it's like phase one and done of just data availability, and that's it. And if you want to scale smart contracts, do rollups. Other than that, you're on your own. That world is it's a big challenge to the way that we think about Ethereum today and its ability to bring everybody into the same tent. We're waiting on layer twos. I think Arbitrum is launching, I think, today, right? I believe Arbitrum is launching today. Optimism at the end of July, I think, and then Matter Labs and Starkware later on in the year. for ZK rollups. So I think a lot is happening on the layer 2 side, but it's not here yet. And the demand's already here. The demand was fucking here, weeks ago, months ago, and which explains largely the rise of Binance Smart Chain and Polygon and all these other blockchains that are taking the overflow from what would otherwise be the demand on Ethereum.
It's almost been relieving though, because as someone, by the way, I always try to disclose like where I hold positions. So like I do mostly hold positions in Ethereum related projects. So I probably have some bias to have zero interest at this point in BSC. And Polygon, I've actually used most of the applications on Polygon, but I've been so relieved that newcomers have been able to find the ability to transact on something like a Polygon, because at the end of the day, I mean, I do personally believe that like the future is multi-chain. It's just that like, I like the analogy people use of like, maybe like Ethereum is like the Manhattan or New York of the DeFi world. Like there's no doubt there's the most opportunities at this point on Ethereum, but it's a great thing that we've been able to relieve some network congestion. I do believe some of the network congestion that's gone down on Ethereum is due to people hopping over to a BSC, to Polygon, to Phantom. But I will say, I think I would remind everyone, so much has happened in just the last 6 months. And we are, like you mentioned, we are so close to so many of these major solutions going live. And, I'm not worried, because like once they go live, people can decide. Like that's the beauty of what DeFi is you decide what to do with your money, pending a team that operates out of a very regulated part of the world, and they put up geo restrictions. But you get the point. Like we're moving towards that, where you should be able to transact from anywhere on earth and be able to move your money in real time.
Agreed. Totally agreed.
Haseeb, there was, by the way, too, I want to just time check with you. So we've got about 15 minutes left. So one of the things that I heard you talk about on, I think it's called the Motion podcast. It was with Taryn Chitra. I'm probably mispronouncing Tarun, there we go.
Yes.
And Meltem was on this with you. And
the Blockchain Debate podcast.
Yes, yeah. So you guys had this sort of debate, and you were actually defending that liquidity mining is an innovation. And like, anyways, I wanted to flesh out if you can kind of rehash like that thesis of why you were saying it was an innovation, because I'm curious to dig into, do you still think it's an innovation? What are your thoughts on like where we are today, in May 2021 in terms of liquidity mining and yield farming?
Yes. So this actually was a debate that took place, I think, right after Comp Token, which kind of kicked off the whole liquidity mining craze summer last year.
Yep.
So we were early investors in Compound. So we invested in their Series A, and I know Robert very well, and kind of was really intrigued. And this was very early on when yield farming first started, and we were all trying to understand, what is this? What is this phenomenon? How does it work? Like, why is it working? And this is still very under theorized. How exactly to think about the effect that yield farming was going to have on the industry. And some people were looking at yield farming and be like, oh, this is just like craziness. This is just speculation. This is just nonsense. Like, this is not going to survive. And my feeling was very strongly that actually, no. Yield farming is an innovation in capital formation. It's an innovation in how projects are able to go out and acquire customers and do the marketing work that they need to do in order to build sustainable products. And the analogy I gave at the time, I think, was something like, in the old world, the old model, like Uber. I remember actually Airbnb did the same thing, but Uber is an easier example to wrap your head around. Uber, there was a time when Uber wanted to give equity to their drivers before they IPO'd, but the SEC would not let them. They were not allowed to. But Uber always, of course, is going to be subsidizing their drivers. It's going to be rewarding them for doing stuff, right? So, for example, whenever Uber enters into a new city, they want to pay out extra bonuses to their riders and drivers, right? Mostly to their drivers in order to get supply up and running in a new city. Now, what Uber has to do if they want to go pay out these people these extra bonuses is they need to go raise money. because they don't have the cash on hand necessarily. So they go raise money from venture capitalists, they sell their equity to venture capitalists, and then in exchange for the cash they get back, they then distribute that cash to the drivers in order to get the network effect to start running, right? Now, if Uber could do yield farming, then what they could do is they could skip the whole thing with the VCs. They screw the VCs, fuck you guys, we don't need you, right? Instead, we're going to give our equity directly to the drivers.
Yes.
And if the drivers want to go sell that equity and go get cash, then fine, you go do that if you want. But if you want to go long our platform, then go long our platform. And so Uber then, one, it ties incentives more tightly together, and it allows you to circumvent this entire kind of extra transactions and transaction costs and slowdown. Where it's like, why go through that? Why is that formalized as a part of the way that capital formation has to happen? It doesn't. It's completely arbitrary that we have to do things that way. Absolutely. So I see as the core innovation behind yield farming. And that's what I argued at the time of why yield farming was an innovation, and I still believe that. However, there's a big however. I think we're now very well past the point where we don't actually really understand yield farming. And here's what I mean by that. So it's gotten to the point now where so many different projects are doing yield farming. But a lot of these projects basically are essentially engaged in what I would call malinvestment. Essentially meaning that they're giving a lot of money via yield farms and liquidity to their users, but they're not getting anything for it. They're actually just wasting that money. And right now, we don't even have a language to talk about what it means to engage in malinvestment in yield farming. Like, we don't have any frameworks for this. We don't have any ways to think about it. We don't have any language. We don't have any common reference points. We don't know how to measure this, right? So to me, it's almost like it's like growth marketing in the year 99 or 98 when the dot-com boom was just taking off, and people were like buying Super Bowl ads with money that they raised from VCs without any real sense of like, where is this money going? What is this money doing? Right. And think about Yearn. Yearn is a perfect example. Yearn takes money, Yearn is a yield aggregator. It takes money from investors, and then it goes and parks it into farms, and then just harvests farms and gives the money back to LPs, right? Yearn only works in a world where basically protocols are wasting tons of money.
Yes.
It works because of the malinvestment, right? It's capturing malinvestment. Now, in the normal world, some of your audience might be familiar with this company called MoviePass. You know MoviePass?
I do. Yeah. This is a great parallel. Please do.
Yes.
Yeah,
so MoviePass was this company, this VC-backed company, that basically what they did is they essentially gave you a pass where you could watch unlimited movies. Okay. And essentially they did this so cheaply to consumers, right? Their whole idea was, okay, we're going to acquire a bunch of consumers by having this like super, super cheap, highly subsidized product, and then we're going to monetize them some other way at some point in the future. I don't know. We're going to figure it out when we get there, right? That was MoviePass. And so they ended up acquiring tons and tons of customers by just fucking wasting money. Like, they just were giving out tons of free money to people, and they just saw a bunch of movies, and the company never made a dime, and then eventually they shut down because their economics were just nonsense. Now, the problem with MoviePass is that you can't arbitrage MoviePass. But you can't actually go make money on MoviePass unless you just want to go and watch movies for basically next to free, right? But you can't like go and financially flip it by turning around and making money, okay? In DeFi, you can. That's what Yearn is. Yearn is you going around and like taking that MoviePass and go selling it for the underlying tickets and arbitraging the difference and then doing it at scale, right? That's what is going on in DeFi today. And so I think when we look back after this generation after this bull run is over, we're going to look back and we're going to realize how much money was just absolutely wasted. But right now, it doesn't feel like we're wasting money, right? Look around you in DeFi. Does anybody feel like they're wasting money?
No.
It feels like it's a big part.
No, wow. I have really never thought about it this way. It's like this industrial scale yield farming. And I've never thought about it the way it's wasted, because I've thought more in the context of you're able to earn that yield. And I've thought how innovative that was of what Yearn offered. And, they've got a very, people clearly believe in the product and they use it. But I've never thought about this, and it's now you got me thinking. Like this is totally what we're going to look back on and say, like, was that the right way to go about it? Because I got a good example that goes with what you're saying. Is I remember when they started the vaults that were farming and dumping Curve. Now, I don't have some huge bags in Curve, but I believe in the Curve project. I've known them for quite a while. I use it. I love it. I think it's one of the best applications that newcomers can benefit from because they're like asset pools. Well, suddenly Yearn is bringing in all of this capital, but they're also dumping the token. And I mean, the token just suffered. I mean, for months, Curve could not recover from it. I'd say now they have a more symbiotic relationship, and I'm wondering if the communities or teams will have something to say about this in the next few years. To say you can see when it was not a great relationship, where it was just Yearn built this awesome product if you wanted to earn yield, but it was actually hurting the protocol that it was benefiting from. And man, that's nuts. That's no one's ever said that to me, Haseeb.
The thing about yield farming, right? Yield farming was designed to. There are two ways you can think about yield farming. Right?
Yeah.
One way is that it's customer acquisition cost. It's a way to get a customer in the door, right?
I love that.
Now, that only really works if it actually gets customers in the door.
Right.
If you get more capital into Curve, that doesn't actually get more customers in the door. Right? It only gets in more supply. It's a two-sided market, right? There's supply on one side, there's demand on the other side. Yield farming doesn't incentivize demand. It only incentivizes supply. Okay. Now there's a point at which you have so much supply that like the problem is not supply, the problem is demand. Right? You need more demand. Yield farming does not do anything for demand. Now there are some protocols that are engaged in what usually is called trade mining. Trade mining is basically where you basically give people a rebate in your own token for trading. So actually Balancer is running a trade mining program. And this is basically a subsidy to the demand side. It's saying, if you want to come trade on Balancer, I'm going to give you a kickback and make it cheaper for you than would otherwise be on another platform that actually has better liquidity, right?
Absolutely.
This is a subsidy to the other side of the market. Now, most protocols, vast majority of protocols only subsidize supply. And the problem with supply, one, supply is not sticky. So we've seen that basically you stop subsidizing supply, it goes elsewhere, right? I mean, that's Yearn. Yearn, by definition, is the most cavalier supply in the world. Yearn is the most fucking mercenary thing. If your yields go down, fuck you, I'm out. I'm gonna go find somewhere else that has higher yield, right? Absolutely. Which is fine. Like it's smart that they're doing that, and it's a good product. People want that, but it takes advantage of the malinvestment that's going on in the space where non-sticky supply. How valuable is non-sticky supply? How much should you be paying for non-sticky supply? And the second question is your problem actually supply? Is that why your protocol is not taking off? And again, we don't have the language to talk about this. We don't have the tools to talk about this. Like all the stuff I'm telling you is like, wow, that makes sense. But like, I'm going to go back to talk about the next project, and nobody's going to bring this up. Nobody's going to talk about this. There's no rigorous way of thinking about these things because this is just the nature of, again, all this happened in 99. Right. When you had .com companies raising tons of money, people realized, wow, internet's the future. This thing is amazing. It's going to be so great. They raised tons and tons of money from investors, and then they all spent it on random bullshit that didn't do anything. Right. And that's the nature of how these technological cycles go. Is that you realize like, wow, this technology is amazing. It's going to solve tons and tons of problems. I'm very bullish on DeFi. I've been an early investor in DeFi. I love it. I think it's amazing. It's going to continue to grow. It's a big part of the story of crypto. I believe everything that I said earlier, but I also think that right now we're in the infancy of DeFi. We don't really understand a lot about what we're doing with these token cap tables effectively. And again, when we look back and we do the accounting 2 years from now, there are going to be a lot of projects that are like, wow, we spent 75% of all the tokens we're ever going to have, and what do we have for it? Like nothing. Basically the people who stuck with us are the people who stuck with us, and everything else along the way was just like, okay, well, what does a Super Bowl ad 3 years ago do for me now? And the answer is very little.
This makes a lot of this. I want to say like what you've described is there's this spectrum, and what you described with Balancer, where they're subsidizing you for trading, is to me like the purest part of this of liquidity mining. It makes complete sense because it's like I'm subsidizing you to trade, and by you trading more, it creates it enables everything to happen in our protocol that we want. More trade volume, more fees. Everyone's happy. Then there's that thing in the middle where, well, there's the example of, hey, go provide liquidity for my token because we need liquidity for this token, and we'll reward you. That's the one where you just don't know. Like if you look at these wallets and you do on-chain analysis, you can see that there are so many wallets that are just receiving it and they're dumping it. So they're helping you by actually providing the liquidity. No question about that. There's those of us, I will say I focus on liquidity mining when I want to be long the reward token. No question about it. I want in on this. I want to earn that token and hold it. All of this makes sense to me. And then there's this sort of mercenary mining that you describe. So one thing, Haseeb, I know we need to cut out here like really like any minute. I had one last question for you though.
Yep.
You made some interesting comments on the Bankless podcast around, I think it was August. Ryan or David asked you a great question about like, what's something that you never saw coming a year ago and that you've realized since then, like, whoa, I was wrong on that. And at the time you mentioned it was automated market makers, DEXs in general, just never had foreseen that they would become so popular so soon, at least. I'm curious, is there anything, it's almost been a year since that podcast, anything else new that you've looked back on and said, whoa, holy shit, I definitely didn't see that thing coming in DeFi?
Binance Smart Chain is the one obvious answer. I did not see Binance Smart Chain coming.
Me too.
And
Me too.
I think this is one that caught a lot of the Ethereum community off guard.
Absolutely.
But it's moments like that are your instinct is to keep finding reasons why you were right or why they were wrong all along, or there's some reason why like oh, Binance Smart Chain, it's centralized and it's this and it's bullshit and it's a bunch of copycat projects and that's why I can ignore it. I don't have to learn something from it. And as an investor and as a thinker in the space, your most important job is to just listen, to just pay attention and really understand, why was I wrong? And what does this tell me about how I should expect crypto is going to play out in the future? I think Binance Smart Chain is one of those things that's a very, very, very important, it's a very important sign of what's to come. And we don't have enough time to like really flesh out a whole lot about what I think there, but maybe next time.
Absolutely. Hey, what a pleasure to finally meet you and talk.
Likewise.
Again, like you do a service to the community with. There's a lot of education that you've done, I think, that actually inspired a lot of the content I try to put out now. And I just want to remind everyone then too, check out the Dragonfly Capital website here. So, if you're looking for a strategic partner, because not all money is equal, I would absolutely be talking with these guys on the team. And then don't forget to follow Haseeb on Twitter. Also, Nakamoto.com that's only your website, right?
No, it's Balaji's website, actually.
Oh, that's
awesome. Yeah. But I work with him on this course.
Yes, he's got a blockchain course there, and it's free. So you should check that out, like free resources to get yourself educated if you're new to the space. Haseeb, anything else you wanted to share before I let you go?
No, that's it. If you're working on something cool and you're interested in bringing on a partner, reach out to us. We'd love to hear from entrepreneurs.
Awesome. Well, hey, everyone, just one last reminder. You can learn more about DeFi at learn.zapper.fi. And don't forget to subscribe at tv.zapper.fi. We'll be back next Thursday or Friday with a new episode. And Haseeb, I'm going to hit this outro video. We'll be in a green room, but you're more than welcome to drop out. So bye, everyone. Have a great day. And here is my outro video. Bye.
See you.